The Japanese yen just hit its weakest level in almost 40 years. Not a decade, not since the financial crisis, nearly 4 decades. And the question most people are not asking is this: why does a currency move in Tokyo matter to you? The answer will surprise you, because what is happening to the yen right now is not just a Japan story. It is a signal about global debt, energy prices, and interest rates, and it is moving fast. Let's go back to the beginning. The yen crossed 162.5 against the US dollar this week. That number might sound abstract, but here's what it actually means. A year ago, 100 US dollars bought you about 148 yen. Today, that same $100 buys you 162. The yen has lost significant purchasing power in just 12 months. And for the Japanese people, that matters enormously. Japan imports almost everything it needs to power its economy: energy, raw materials, food commodities, all priced in US dollars on global markets. So when the yen weakens, Japan pays more for everything. That creates a very specific kind of inflation. It is not just rising prices. It is rising prices driven by a currency you cannot easily control. Now here is where the Iran conflict comes in. The war in Iran sent energy prices sharply higher earlier this year. Japan felt that harder than almost any other major economy, because Japan has virtually no domestic energy production. Every barrel of oil gets purchased in dollars. Every dollar the yen loses against the dollar makes that barrel more expensive. Inflation climbed. Bond yields climbed with it. The 10-year Japanese government bond yield rose to 2.78% this week. That was 2.60% just 1 week earlier. That is a significant move in bond market terms. Hold that thought because it becomes important in a moment. The Bank of Japan has been trying to navigate this carefully. They have been raising rates slowly to fight inflation. But raising rates too fast risks crushing Japan's enormous debt load. Japan has one of the highest government debt to GDP ratios in the developed world. Higher rates mean higher borrowing costs on that debt. It is a trap with no clean exit, and investors know it. Now add something that arrived this week on top of all of that. The Japanese government announced a 370 trillion yen spending roadmap. That translates to roughly 2.3 trillion US dollars. A massive public-private investment plan designed to modernize Japan's economy. On paper, it sounds like economic stimulus. In reality, bond markets responded with alarm, because that kind of spending requires issuing enormous amounts of new government bonds. More bonds in the market means prices fall and yields rise, and rising yields in Japan's bond market creates ripple effects globally. This is where things get genuinely interesting. Japan holds more US Treasury bonds than almost any other country on Earth. When Japanese yields rise, Japanese investors start weighing their options. Why hold US Treasuries at lower yields when Japanese bonds are paying more? If large Japanese institutions start rotating out of US Treasuries, that pushes US yields higher too. That affects American mortgage rates. It affects the cost of corporate borrowing in the US. It can put quiet upward pressure on interest rates across the developed world. One currency move in Tokyo, multiple consequences in living rooms across America, Europe, and beyond. If you are finding this useful, consider subscribing for more practical financial insights. Now let's talk about the carry trade, because this is the mechanism most everyday investors never hear explained clearly, and it matters more than almost anything else right now. A carry trade is simple in concept. You borrow money in a country where interest rates are very low, you convert that money into a currency where interest rates are higher, you invest it there and earn the difference. Japan has had extremely low interest rates for decades. That made the yen the world's favorite carry trade currency. Investors borrowed cheap yen, bought US dollars, and invested in higher yielding assets. It works beautifully when the yen stays stable or keeps weakening. And right now the yen is weakening, so the carry trade is attracting more money, not less. More investors borrowing yen and selling it for dollars pushes the yen down further. It becomes a self-reinforcing cycle. And here is the part that gets uncomfortable. When carry trades unwind, they unwind violently. We saw a version of this just last year. A sudden Bank of Japan rate hike triggered a rapid yen surge. Carry trade positions were liquidated within hours. Global equity markets saw sharp multi-day sell-offs, not because earnings changed, not because the US economy changed, but because of a currency move in Japan. This week, Japanese authorities were reportedly ready to intervene in currency markets again. The yen recovered sharply on Thursday amid that speculation, but speculation is not a solution. Intervention can temporarily slow the yen's decline. It cannot reverse the underlying forces driving it. Energy dependence, rising debt, a government borrowing more, a central bank hiking cautiously. These are structural forces that take years to resolve. So what does this mean practically for someone watching this video? Let's break it down by where you sit financially. If you hold international mutual funds or ETFs with Japan exposure, currency drag is real. A portfolio that delivers 10% returns in yen terms might deliver 4 to 5% when converted back to dollars. Currency matters as much as the underlying asset performance. That is rarely explained clearly to retail investors. If you are in US Treasuries or bond funds, watch Japan carefully. Any shift in Japanese institutional flows out of US debt pushes American yields higher. Higher American yields mean lower bond prices. That affects the fixed income side of balanced portfolios directly. Purely on US large caps, the carry trade is your wild card. A sudden reversal in the yen carry trade has triggered equity sell-offs before. It could happen again, and it typically happens faster than most investors can react. And if you are a complete beginner just learning how markets work, here is the simple version. When the world's third largest economy has a currency crisis, it does not stay contained. Money flows globally in milliseconds. What starts in Tokyo lands in your portfolio before the news alerts catch up. The yen at its weakest in 40 years is not a distant financial curiosity. It is a live variable in the global investing equation right now. Markets are watching whether Japanese authorities intervene again. They are watching the Bank of Japan's next rate decision. They are watching whether that $2.3 trillion spending plan triggers another bond yield spike. Every one of those outcomes changes the carry trade calculation. Every change in the carry trade calculation moves global capital. And global capital moving changes prices everywhere. The second half of 2026 was already going to be shaped by inflation and Fed policy. Now add a 40-year yen low and a $2.3 trillion Japanese spending plan to that picture. The people paying attention to currency markets right now are looking at the full picture. Most investors are still only watching half of it. That gap is worth understanding before the next move happens.